Hey everyone, it's just Bill here from Envision FX. I'll just do a quick intro. So we're a small group of successfully funded traders, and we primarily trade Forex, and more specifically the one currency pair, which is Euro USD. So with our strategy, we actually can extract unheard of percentages. So there's actually no need to trade any more pairs. However, this strategy does work across all asset classes, as essentially we're trading how the market is moving from the daily down to the minute. So literally down to the second. So we do a top-down analysis and we place entries on the minute and the seconds time frames. So firstly today, I want to share with you guys some of our concepts. So today I want to share with you guys expectational order flow, or EOF for short. So what is expectational order flow? Expectational order flow is the flow of orders initiated by banks and financial institutions. It is also the transfer of money which is expressed on the charts as ranges, and then the market is actually moved in the process of mitigating the ranges. I'll explain this further in some diagrams and I'll show you how it relates to the charts. So why is the word expectational in there? That comes in as we now can have a future expectation based on the flow of orders and position ourselves better in the markets as traders. Firstly, as far as how we're looking at it, let's have a look at this concept in the center here. Also, bear with me here because this is not some polished, over-edited recording. I'm just jumping on, showing you guys concepts. So bear with me if I ramble on or am muttering or something. Anyway, let's have a look at this. Banks will initiate a direction. Okay, so we have a range here. Let's get rid of that. I'll talk about supply and demand another time. So we have this range here, and it's pushed to the upside. So we've had a break of structure here. So what this means is the banks have initiated direction here. They've placed orders here and they've pushed the market long. So what happens then is banks sell back down to buy back up. What we want to do is follow in the footsteps of the banks and financial institutions. So when they push price back down to these ranges here, I'll zoom in a little bit. So they push price back down here to mitigate this range to then push price back up. So this is where we want to get in. So I've got it written here, banks mitigate out of their positions. They mitigate this range to the left and then continue the flow. Okay, so this is order flow. So we're looking to take this here and this as a continuation long to break this high. And that is also what makes up a trend. We will jump down to the lower time frames in here and look for a shift in momentum to take our trades. And I'll show you some more examples. Let's look at the same concept a few times. We'll keep repeating it because you only get better with repetition. All right, same thing. We have a range. It's not a very good drawing, is it? Let's just leave my drawing on there. We've had a break of structure. So we've dropped to the downside. Again, that means that banks and financial institutions sold here. So we have a break of structure. Once we have a break of structure, what happens? We always have a pullback. Always. So we break structure. You don't want to be selling or anything here. You wait for the pullback to mitigate. So this is the high of the range. This is the low. So this box is showing you the range. This mitigates the range to then continue. So you want to be selling on these mitigations. Okay? And so on and so forth. What's our expectation of the trend? Once we mitigate, we then break structure again. That happens over and over again. So then we pull back, again mitigate the range to break the low again. This is how the banks are initiating direction. So same with this. So this is like a version of long, I guess. So we've ranged, pushed up, mitigated, pushed up, drop back down, mitigated to push back up again. I don't know why these lines aren't drawing on very straight, are they? Alright, same thing over here. This is just a sell as well. So same thing. As soon as you see a break of structure, it means, and an impulse in a certain direction, it means banks and financial institutions, BFIs we're going to call them. So let's just shorten it for BFIs. I've got it written up here if you forget what it is. So they've pushed price down. Again, we get a break of structure. After we have a break of structure, what happens? We get a pullback. We pull back, mitigate the range. What I mean by mitigate, we just tap into it. That's what we need to know. We tap into it, then continue the move down to break structure again. And what happens after we break structure? We pull back again into the range that caused the break of structure to drop back down. So what I mean by that caused the break of structure. So because they've placed orders here, this is the range that caused the break of structure. So just remember that. There's certain ways you can look at it as well. I actually call them weak highs and weak lows. I mean, it doesn't really matter because it's just order flow. It's just a way of mentioning it. So if I look at this diagram, if we break structure, we go long, and we're expecting to pull back to go long. So we're expecting this high to break here. So we're buying down here, expecting this high to be broken, expecting to get ran through. So you can call it a weak high because it's going to be weak. It's going to get ran through. And the same goes for the sell. So we've had our break of structure, we've pulled back, and we're expecting for this to break. Right, so same thing again here. We've had our break of structure here, we've dropped down. So our expectation now is for the price to pull back into the range that caused that break of structure to then drop again. And that's expectational order flow. We're following these mitigations of the ranges. And essentially, that is where the bank's placing their orders. It's a transfer of money. So the money was in this range, it got transferred to this range, it got transferred to this range, and so on. Transferred to this range. So now we're expecting this one to mitigate, to drop again. So this is what I mean by the transfer of funds or transfer of money. So let's get rid of those. Hopefully that sums up a little bit. And you're probably wondering what these green boxes are here. This is premium and discount pricing. You just need to remember this. The top is premium, the bottom is discount, and the middle is the equilibrium. What happens when they initiate prices? Banks are buying back up. And why are they doing that to mitigate this range? Like why? They're doing it to get a better price. A good way of looking at it is if we're expecting something to be cheaper, we might go to a shop on a certain day because it's going to be a better price on a certain day. So banks are just trying to get a better price and they need to mitigate out of their positions. They're selling to buy back up. Once they initiate direction down, we don't want to sell in the bottom half. So this is the middle, the equilibrium, the top's premium, the bottom's discount. We only want to be selling in premium prices. So we measure the impulse. So the impulse started there and it pulled back there. So we put that tool that just measures the 50% there and we only want to sell in the top half and vice versa. So over here, we've had our break of structure, we've dropped all the way back, we only want to be buying in this half. Again, we want to follow in the BFI's footsteps and we want to get high probability trades. We want to do the same as the banks. We want to buy low and we want to sell high. And I'll show you how we can see this on the charts. It's how the market is moving. I'm going to show you down here exactly what I mean with some actual candles. Let's jump time frames. Right now, for example, let's have a look at this. I think it's important to do multi-time frame analysis. Like right now that looks like just candles going down. You can't really see what's happening on the daily. But let's go down and I'll show you what I mean by mitigating ranges with the actual candles. Let's draw it out. As we're trending down, what happens here? We have a break of structure and we pull back and we drop again. And why? Let's mark out the ranges. Here's a little range here. So what happens? We've had our break of structure. I'll just draw a line in to symbolize it. And now let's get this tool on to measure. So we drop down. We've pulled back up into premium. We're above the line to sell again. So we can be selling in here. Okay, so we're in the 45 minute. When we take trades, like I said before, we take on the 1 minute and the seconds. So we're getting into these trades here with tiny stop losses, 2 pips. So this big. So obviously we can refine this a lot. And that's the thing, on these lower time frames, you really can make huge percentages. So we did sell here, and I'm just going to show you how the ranges are mitigating further, just so you get more of an understanding of it. Just trying to show you a fair few examples. All right, so we'll show this again. We break. I'll just draw the top and the bottom of the range. We mitigate it. We break again. What does this blue candle do? It goes back up, mitigates a range in here on the lower time frame. We break again. Maybe we need to drop down a bit. I can see it because I'm good at candle merging. I am going to do more webinars on candle merging and understanding price, because it really is a learnt skill. But once you know it, you'll have no trouble extracting a lot of percentages out of the market. All right, I've drawn the ranges. Range there. Range there. Now drawing some breaks of structure. There, there, there. Here's an internal one here. All right, so what happens? We break, we mitigate, so we can sell. We break, we push right back up, so we're going to be selling here. We break here. This candle mitigates the range. Okay, there's one thing that I need to add. When we have a range like this, and it's coming back up to mitigate, the minimum mitigation we're looking for, so that's the low of the range, that's the high of the range, is the edge of the range. So it can mitigate anywhere inside of this range, but the minimum is there. Draw another one. Price drops down and goes to there, I won't be looking for an entry because it didn't tap it. It has to hit there for me to look for an entry here. But it's even better if it goes in here. As long as it taps into this and doesn't break the high, because then you have to change the trend and you can go long. See how down here this is tapped the open, rejected, tapped in again, rejected, tapped in again. Let's talk about money transfers again. Banks have sold here to buy back up, sold here to buy back up, and we're just watching the flow of money go down. And that's just essentially what's happening. Again, break of structure, we have a pullback to the range that caused the break. So what? We sell here, and I did sell here. Again, there was multiple entries here. Again, we're on the 45 minutes, so you can imagine, and again, I rarely go over 2 pip stop. Like, plenty of trades in here. I'll leave these ranges on just so you can see how they're tapping into each other. All the markets is a whole heap of ranges interacting with each other. Now look at this. We have a break of structure again, so we're expecting our pullback. We got the pullback. Let's say this is our range, and this didn't play out. And why did it not play out? You got to look at where we are. You've got to look left. We're actually at a high time frame demand area, but we're going to talk about supply and demand in another webinar. But for now, I'm just going to keep talking about these concepts. Again, what happens? We break structure to the upside. And then what happens? We pull back right down to discount. And again, this was an entry. It's more clean on the 15, but it's even more clean on the 1 and lower time frames, but I won't dive into that. I have a Discord for that. Same thing. So we had the break right back down to discount. So great buying opportunities. And now let's watch how it moves up and exactly what happens. This is a great demand area. We push up, we break, we react from here. So if you were to sell here, which we also did, this is still a big move. Like, you're getting in with 2 pip stops. There's a lot of percent to be made here, but you at least get some percentage out of it. But you know, because you've tapped into a good area and you're now trending long, what happens? Let's zoom out a bit. We have a higher time frame range. And the same thing applies. What happens? We break, we go back around, we mitigate to then go long again. And the same thing here. We have a higher time frame range. This is the high. This is the low. We drop down to mitigate. There's also a range in here. This mitigates, then break up. This is how we're looking at the markets. And I'll just keep showing you examples. We went long here, 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 we went long here. Based on expectations, just remember, let's look about this again. Let's just go through this. I'll put on the brakes of structure. So we have the break of structure here. And what does price do? Breaks up, comes right back down. So the discount is from here to here, taps right into the equilibrium to go long again. So if we're going long here, we're expecting for this to be a weak high to get ran. And what's it do? It gets ran. Then the same thing again. Let's get this same tool, measure the impulse. All right, let's get rid of some of this stuff. Same thing. So what happens? All right, let's neaten it up a little bit. Same thing, we broke this high. What happens when we break the high? You can't buy, you need the pullback. We get the pullback right down the bottom. And it's a lot clearer on the lower time frames, this one. This was a great entry here. It's the same thing, right down the bottom, and what's our expectation for this to break? And what happens? It breaks. So this is exactly, again, how we're watching the ranges mitigate, how the market's moving. And when you can't see the ranges mitigate, you need to change time frames, and then it makes more sense. I'll go up time frame and you'll see how it changes. Let's delete all of this. Let's have a look at this. That's our range high, that's our range low. On a higher time frame, what happens? We break, we mitigate, then we break the week high. The exact same thing. That's the 4 hours. So look at where those cells were that we were looking before. They were right here. And it looks like nothing on these time frames. Here's another little trick as well, and this will be another webinar. Wicks and candle merging. So I know when I see a negative wick and a positive wick, I know that's a range. You get really good at reading candles. I know that's the low of a range, I know that's the high of a range. We broke the low, then this wick came back up and it mitigated to drop again. And this is the exact same spot that I was just showing you before. Let's have another look at it. I have the frozen computer. Yep, there we go. I just want to show you. So let's mark out the high and the low. And let's see what this is. And I'll just show you what I mean. So that is a range, but you can actually refine the range to this one here. When you jump between time frames, you'll end up refining the ranges. Let's look at some more examples. Let's have a look at this big trend up the top here. Exactly the same story. So we're trending long. We have a high, we have a low. We break this low and we change sentiment. So this is a high time frame breaker structure to the downside. This is what causes starting to trend down, okay? We had a break. So we measure this whole impulse from the top to the bottom. Remember, it's a bit more messy this, but it's the exact same thing. So we measure this impulse and make sure we're in the premium to then sell again. Where did we go? We had a break, we went right back up. So this range caused the breaker structure. So our expectation is now, once we're selling here, for this low to break here. And it's exactly what happens. Same thing. As soon as we break structure, we pull all the way back up to a range that caused the breaker structure, and then the exact same thing happens again. Let's have a look. This is cleaner on the higher time frames, but it's the exact same thing. All right, let's have a look at here. There were some great trades in here. Let's zoom in. We have this range. We break structure. This is major structure, we break it. And what do we get? We get our pullback. So this is the high of the range, this is the low of the range, a higher time frame range. You can refine it to here also. But if we get a momentum shift, when we tap into this high time frame range, it's a great spot to be selling. And how do I know it's a great spot to be selling? Because of the premium and discount and equilibrium. So let's measure the impulse. So the impulse is over here, and look where the wick went to. Right, let's zoom in. Probably a bit hard to see. This is the equilibrium. It's right in line with that range. We tap into that. On the lower time frames, we've got a change in momentum and we got entries. Anywhere in here, we'd be looking for entries. But quite often we get the mitigation at the edge of the range to continue price. Now let's zoom in and look at the exact same thing happen again right here. We get a break of structure to the downside. Same thing, pull back. Where do we pull back up into? Above the equilibrium to then sell again. And the entry is on a lower time frame. And it was a mitigation of the range in there. But also, what's our expectation? We have bearish flow, range mitigation, break of structure, we get our pullback, so we're now expecting for this to break. And that's exactly what happened. Go back down to where we were looking before, and let's do it all again. So we have our impulse, expecting price to come up to here or even up into here to then drop and continue the move down. And what do we have? Let's move this up a bit, say the impulse is there. And what do we have right on this equilibrium? We have a range. So this could potentially be mitigated to drop further. But what you've got to remember, on a lower time frame, see these wicks? The same thing, that's also a range. There's been a sell money transfer from here to here. So there could have been orders left in here. So this could be enough orders for this, all this liquidity. We'll talk about liquidity in another webinar. It could be enough orders for all of this to get ran. I'll show you this on some higher time frames as well. So let's go out, let's just zoom right out. Again, time frames don't matter. I can use any time frame, but I really like the 1 minute and the seconds for entries because you can get pinpoint accuracy. Now knowing what I've been talking about, what do you see here? Let me explain it. Big range. Initiation, mitigation, continuation. Huge, on a huge time frame. And also there's a range in here. If you zoom in, you can refine it. So there's a lot of refining. You refine from a higher time frame to a lower time frame. Had a mitigation of this massive range to go long again. Let's zoom right in, delete that and see what we see. And these were great longs. This was back in April. Let's just bar replay. Let's go down to here. But it's the exact same thing. What do we see? We have a high time frame mitigation to the left, a strong demand. Again, we'll talk about supply and demand later. Break of structure, price comes back down. I don't even need to put that tool on because I just know this is discount. See those wicks? There's a range there. This mitigates the range to continue. And I went long here. We're on the 7-hour time frame. I went long on the 1 minute in here. And the exact same thing up here. Look at what happens. We break back down into discount to go long again. In fact, let's zoom in on this. I remember there's some pretty nice. Let's see what we see in here. Zoom in. What are we expecting? We have our break of structure here. We get our pullback. There's the high range, there's a low of the range into here, so we can take longs here. Then internally, so this is the buy, so this is the impulse, that's a high of the impulse, that's the low of the impulse. So you know how what we do, we box off that or we measure that and we want to be buying down the bottom. Okay, so just need to always remember that. We'll talk about ranges another day as well, we'll go deeper into them, but what do we get? So we mitigate down here, then we get another break of structure, then we pull back into the range again, then another break of structure, pull back into the range again to go long. So see how it's repetitive and it's fractal. So what's happening here happens on all time frames, and if this is a bit messy, just go up a time frame, it'll be neater and you can find what's the neatest. And I'd just like to add that this way of trading, or how the market's moving now, it's been moving like this since the beginning. literally, like I can, as far as I go back, it's always been moving like this. Moving from range to range, mitigating the range, and then pushing on, and it's being moved by the banks and financial institutions. I'm going to leave it at that for today, everyone. I hope you've all enjoyed listening, and thank you for listening. I hope you all learned something. You are all welcome to join our Discord community. I'll leave the link in the bio. It is a group of like-minded traders discussing trades, and we share our breakdowns of trades that we take on a daily basis. Thanks again, everyone, and welcome to Envision Trading.